Hey everyone, this is Ryan Chen here of Loan Care. In this video, I'm going to show you what to do after the bank rejects your loan. So you apply for a business loan and the bank said no. Now what? The worst thing you can do is go apply somewhere else, because every time you reply without fixing what got you declined in the first place, you're making your file even worse. And after personally funding over 300 business loans, I can tell you that the same 6 problems shows up on almost every denied file that comes across my desk. But there's one that matters more than the other 5 combined, and without it right, nothing else on your file reads the right way. So in this video, I'm going to break down all 6, show you exactly what your bank saw when they said no, and give you the fix for each one, so the next time a lender pulls your file, they see a business they actually want to lend to. Now, the first one is something most business owners create without even realizing it, and that is too many recent inquiries. See, most business owners think applying to more banks give them a higher chance, but in reality, it does the opposite. Every loan application triggers a hard inquiry on your credit report, and when the lender opens your file and sees 3 or 4 of these over the last 90 days, each one of these inquiries tells them someone else already said no. On top of that, each inquiry knocks your credit down by a few points. So by the time you get to lender number 4 or 5, the score they're pulling is already lower than what the first one saw. And now you're finding 2 problems instead of 1. And the fix here is straightforward. 1 strategic application after your file is clean will always outperform 5 rushed ones. And you can pull your credit report today and count the inquiries from the last 6 months to see exactly where you stand. Now, even if you only apply once and got declined, there is a good chance your credit report is already working against you in a way you haven't checked. And that's number 2, credit utilization. That is the percentage of your available credit you're currently using, and most lenders wants to see it below 30% of both personal and business lines. A business owner with a 720 credit score but 85% utilization will actually look riskier to an underwriter than someone with a 680 and 20% utilization, because high utilization tells them the business is already leaning on its existing credit, which means the fix has nothing to do with earning more money. It's about how much of your existing credit you're using at the moment you apply. So pay down your revolving balances before you apply, or call your existing lenders and request credit limit increases to bring the ratio down without paying anything off. And you can check your utilization number in 5 minutes on any credit monitoring app. And that brings me to the third one, which catches a lot of business owners off guard because they assume if the revenue is there, the loan should be too. Number 3 is cash flow inconsistencies. Revenue and cash flow are not the same thing, and underwriters knows the difference. They don't just look at how much money comes in, they look at how consistently it shows up on your bank statements. They pull the last 3 to 6 months of deposits, and what they want to see is a stable or upward trend. If your statement shows 80,000 on 1 month and 30,000 on the next, that screen tells them they can't predict what the next month looks like. And unpredictable cash flow is the fastest way to get file flagged. I've seen businesses doing 1.2 million a year get declined, while one doing 600,000 get approved, purely because the small business has tight, consistent deposits every single month. Now, everything I just covered, you can check that on your own file today. But the next 3 are the reason I see business owners come to me after their 2nd or 3rd decline, wondering what they keep doing wrong. And 9 times out of 10, the answer has been sitting right there in the file the entire time. Now, before I break down these exact 3 and show you how to fix the one that overrides everything else in your file, if you want us to look at your specific situation, I will leave a link in the description. Our team will pull your numbers, tell you exactly which of these 6 is holding you back, and show you what your fastest path to an approval looks like. Now, number 4 is one of the most frustrating reasons to get declined, because that has nothing to do with whether your business can actually carry the loan. It is documentation gaps. See, a lot of business owners get declined not because your business can't support the debt, but because your paperwork doesn't prove it. Bear in mind, underwriters can only work with what the file shows them, and where there are gaps, they fill with assumptions that never go in your favor. The most common reasons I see are P&Ls that don't reconcile tax returns, bank statements that are missing months, financial statements that hasn't been updated. And the good news is that cleaning this up is one of the easiest wins on the entire list. Most of the times it takes a week with a decent bookkeeper. And once your documentation is tight, the underwriter spends less time looking for reasons to say no and more times building the case for a yes. But a clean file only gets you halfway there if you walk in asking for a wrong thing, which brings me to number 5, wrong product match. A bank declining you does not always always mean your business can't get funded. Sometimes it means you walk in asking for the wrong product and the bank was not going to redirect you because that's not how they operate. So a business owner applies for a traditional bank term loan and gets declined because they don't meet the collateral threshold or the 2-year time and business requirement. While Business HELOC or SBA Express to a different lender would have been a straightforward approval. And with the right product, the same business gets funded. Because walking in the bank and asking for a loan without knowing which product fits your situation is like walking into a pharmacy and asking for medicine. And the fix is understanding the full product landscape before you apply, not after you get declined. Now, every one of these 5 is worth fixing, and I've seen each one turn a decline to approval on its own. But I also have seen business owners clean up all 5 and still hear no. And every single time that happens, it traces back to the same place on the file. This is the one I've been telling you about since the beginning of the video, the one that matters more than the other 5 combined. Number 6 is your debt structure. Now, all of that comes down to one number that every underwriter checks before they look at anything else on your file: the debt service coverage ratio. DSCR is your net operating income divided by your total monthly debt payments. And if that number falls below 1.25, most lenders will not touch your file, no matter how strong everything else looks. For example, I had a real estate deal where the valuations of the property is $2 million, and that collateral is strong, but the market rent for the real estate is extremely low. And so the DSCR is below a 1.1, or meaning for every dollar of mortgage payment they make, the rental income was not going to be sufficient at a 75% cash out LTV. The maximum lendable amount to 65% LTV, because that's what gets us to a 1-to-1 DSCR. Now, most lenders will want to see a 1.25 DSCR, and that is the number that overrides everything else on your file. You can have strong credit, solid revenue, and clean documentation, but if your existing debt payments are eating your cash flow, no underwriter is going to pile more on top, which means every dollar of existing debt service is actually working against your next approval. And that number does not improve just because your revenue goes up. It only moves when your payment structure changes. And that's where the fix gets counterintuitive. See, the path to approval is not always paying off debt. Sometimes it's restructuring when you already own, so your monthly obligations drops and your DSCR comes up. And replacing 3 stacked MCAs with 1 longer term loan can take your ratio from below threshold to well above it without adding a single dollar of new revenue. For example, I had a client with 4 MCAs ask for a line of credit, and using his real estate, we were able to restructure the MCAs, pay it off, and so now his monthly DSCR drops below or increases from where it was previously. And even though the real estate mortgage is being pulled from the same business checking account, the monthly DSCR was significantly higher in terms of their score, their ratio, than it was previously with those 3 MCAs. And that's what allows them to get approved for the next line of credit. The business that owns less per month will always get funded before the business that earns more per year. And once your DSCR is above that threshold, every other problem on this list becomes dramatically easier to solve, because lenders are now looking at a file they actually want to say yes to. Now you know what your bank saw when they said no, and you know which one matters more than the rest. But here's what I have learned from doing this over 1,000 times. The difference between getting approved and getting declined again usually comes down to the order you fix these in. You structure the wrong position first, apply for the wrong product, or reapply before your DSCR is above threshold, and you're back to the same answer from a different desk. And that is exactly what we help you avoid at LoanCater. We pull your full file, look at your DSCR, show you exactly what lender sees when they open your application. From there, we map out which of these 6 to fix first, match you with the right product, and build a path from decline to approved. We have done this over 1,000 times across 50 lending partners with a 60% approval rate. So if you want us to look at your numbers as well, I will leave a link below where you can fill out a quick form, and our team will reach out with the best moves you can do in your situation. Thank you for watching, and I will see you guys on the next one.